Hello, and welcome to Tracking Error, the podcast about money and markets. This is a Bridgwick Partners production. Let's get to it.
This podcast is for informational and entertainment purposes only and is not investment advice. Please do not take anything discussed as a recommendation. Contributors to this podcast may or may not have positions in the themes discussed. Do your own research and speak with a regulated financial advisor. Full disclaimer in the show notes.
Well, welcome to the second episode of the Tracking Error pod. The more astute of you will have realized that I'm not in my dining room. We are in a studio and there's a video this time, which must mean that we have our very first guest. So Alex Dryden, welcome to the pod. It's really awesome to have you.
Thank you very much. It's a real privilege to be your first opening guest for
Numero
this podcast.
uno.
Absolutely. This is very exciting.
Is this the professional highlight of your day
Absolutely.
so far?
Yeah. Well, it's only about 10 o'clock. So yes, absolutely it is the professional highlight of my day.
Okay, good.
So
Well,
far.
that's good to hear. So I'll give you a quick intro. So Alex is the global head CEO, founder of Financial Fables.
Thank you.
A
Yes.
Go Anywhere newsletter that covers economics, markets, investments, the whole shebang.
The whole shebang.
Right?
Yeah, the whole shebang.
You've been writing since August 2023, almost religiously on a weekly basis.
Yeah.
And the topics are super broad. Gold, debt for nature swaps, negative yield. So there's a big book of work and it's very, very broad. So if you're not already subscribed, what have you been doing, number one? But two, there's lots to explore. So that's very exciting for those people that aren't already subscribed. Now, as a side hustle to Financial Fables, you're also pursuing a PhD in economics. We're going to come to that in a second. And before academia, you were at JP Morgan in the asset management division in the sort of almost mythical team that created and publishes Guide to the Markets.
Yep, all of that's correct.
That fabled publication. So anything I missed there on the intro? Is that
No,
about
that's
right?
a pretty good introduction. Yeah, you've
Okay.
covered off all the big points.
Okay, cool. So today we're going to deep dive into a few of your recent notes and go through those. Reminder that, these views are our own and this is not investment advice. You know the questions I'm going to ask, but I have no idea what you're going to say. So this is going to be interesting. Let's strap in. Before the recent notes, though, I do want to start with your PhD.
Yes.
Because from the seats that you and I both sat in, which were similar-ish seats, there's a fairly well-trodden path for people to go to university and do an MBA.
Yep.
And pivot within the industry or to a different industry. But academia and getting a PhD is more uncommon, I would say. So could you just talk through the motivation for that? Like what were you thinking about when you made that transition?
Yeah, because for most people who's listening, the common pathway is you leave academia and you come into the financial markets.
Yeah.
There are very few people like myself that have committed what I call financial suicide here and left banking to go into academia. Now, what was the thought process? After about 10 years working for JP Morgan, I'd really enjoyed it, but there was something that was missing. I think a lot of the research that I was doing, a lot of the conferences I was presenting at were fantastic and they were exciting. But what it felt like a lot of the time was that I was just commentating on whatever was on the front page of the FT or whatever Bloomberg or CNBC had blasted across the TV at that point. There was a lack of depth to the whole thing. And what I really was looking for was to go much deeper into a topic, really try to understand it and to have that time and space to be able to explore it. And that just wasn't possible at a bank like JP Morgan, or in fact, any real financial institution who want to see insight, they want to see it quickly, and then they want to push it out. And unfortunately, good research takes time, and that time just wasn't available. And so after a lot of thought, after a lot of head scratching, after a lot of sort of tossing and turning at night as to whether or not this was going to be the right financial decision, I eventually decided to take the plunge. I haven't looked back. I've absolutely loved it. But that was sort of the thinking and the process behind that big switch from leaving banking, getting into academia.
And so into that depth of research, your thesis topic is sovereign default events and capital market reaccess.
Yeah, so it's evolved a little bit since then, believe it or not.
Okay.
So my love and interest is when sovereign default. I find it fascinating to see when a government decides that they're going to walk away from their debt burden or stop paying international creditors, and watching why they do that and then what happens next, I find absolutely fascinating. Whether this is Russia's default in 1998, Argentina is a perennial defaulter over the years.
There,
More recently, we're seeing countries like Mozambique and Sri Lanka default on their debt for differing reasons. So that's why I find it very interesting. Now, since I've been pursuing this thesis, it's evolved a little bit. This is one of the natures of PhDs that you find, is that what you go in thinking you're going to study ends up evolving and changing over the years. And for me, where I'm still in and looking at sovereign defaults, but I'm looking at it in the context of natural disasters and environmental catastrophe. So does the onset of an earthquake or does the beginning of a drought, is that enough to trigger a sovereign default?
So like a Pakistan, for example.
Exactly. Absolutely. Or, for example, Grenada in the Caribbean being hit by a gigantic hurricane in 2004. That was enough to cause a default within about sort of 2 to 3 months. And trying to explore how that happens, why that happens, and the decision-making processes of government officials around that, I find absolutely fascinating. So that's what I'm meant to be doing. However, one of the things I will say to your listeners, if they're considering ever doing a PhD, what ends up happening with your PhD is that is meant to be your focus, but you get awfully distracted by what I call side quests, which are other cool, very interesting projects that you get involved in that have nothing to do with your PhD and distract you from the main quest, which was finishing your thesis.
Interesting. And that comes out in, these are then papers that are published, or they're real side quests that are just kind of interest only?
For me, side questing has looked a little bit different from, say, some other PhD students, perhaps. But like for me, I've done a lot more on, for example, setting up financial fables and talking about the financial markets. I've loved doing that. That's been a side quest for one.
Yeah.
Some of the side questing has also been writing papers, but also currently I won't disclose it on this podcast, but I'm currently advising a sub-Saharan African economy on how to do a debt swap, for example. All of that takes time, and that has nothing to do with my PhD, thesis, which is meant to be the main goal. But a lot of that stuff is what I think makes life in academia really interesting, is these different projects, these different experiences that I wouldn't have got to do under the JP Morgan umbrella.
Absolutely not.
I'm very appreciative, just to be clear, anyone who is listening from JP Morgan, very appreciative for the bank. The pedigree that it's and endorsement that they give you is incredibly helpful in academia. People know and recognize the brand and sort of immediately like, okay, I'll give you a little bit more time to listen and explain your point. And it's definitely given me sort of a very sound grounding in how financial markets work and operate. So absolutely, I do not regret working for JP Morgan, but the diversity of experience in academia is fantastic.
Interesting. Yeah, awesome. Okay, let's move to the meat of this then, and some of the recent notes from Financial Fables.
Sure.
So let's kick off with current asset prices, current valuations of asset prices. I like starting here because I feel like if you left Earth for 5 years and came back and you needed, for some reason, to figure out what's happened in financial markets or where capital markets currently stand, you could look at the valuation price earnings ratio on the S&P 500 and have a reasonably good understanding of kind of what's baked into consensus. Like that single number tells us a lot around what's already kind of in the price. Now, you've written, I think, 8 notes with the word bubble in the title.
I didn't know that. Okay, fine. There's a bubble in how much bubble chat there is, by the way, but that's beside the point.
So I think that, I know you're a West Ham fan. You weren't talking about your plight at the bottom of the Premier League. This is more the kind of asset prices down 40% kind of chat. So let's start broad on that. How do you see the kind of current landscape for current asset prices, and are we in a bubble?
Taking a big step back, what forms asset bubbles? Because I think people are very quick to get into the media hype of it all, but actually, if we take a step back, there is a sort of series of ingredients required to start a bubble. And it's the same ingredients that you need to start a fire. One is heat, the other is oxygen, and then you need the sort of trigger. And it's the same with an asset bubble. the heat comes from sort of the speculatory pressure. You need relatively cheap credit to get the flame going. And then what you start to need to be able to do is some element of sort of new technology to act as the wood to get everything fired up. And there was this great paper from Quinn and Taylor talking about the history of asset bubbles. And what they talk about is different types of asset bubbles. Some are more dangerous than others. Back in, say, the 1920s, there was in the United States a gigantic asset bubble that inflated up and popped in 1929. It was fueled by cheap credit, a speculative frenzy. It blew up the equity markets, and the aftermath of that was significant. There were also asset bubbles. For example, about 120 odd years ago in the UK, we had a bubble in bicycles, for example. Everybody got very excited about bikes. Bike shops were setting up everywhere. They were selling loads of them. But when it popped and it all came crashing down, it didn't really pull the economy under. There wasn't a lot of money being lent to bike companies because of it.
Yeah.
And so Quinn and Taylor do this really nice job of sort of talking about different types of bubbles and what I've tried to do in my piece is to think about, okay, how does that apply to today's AI bubble, for example? And today's AI bubble, when I started writing about it in sort of September, October, November, I had it down as a relatively benign bubble in that it wasn't something I was super worried about if it were to pop and the ramifications on the economic environment. The reason being is that a lot of this was sort of equity-led speculative investing going on and a lot of excitement around a handful of names, those names being Google, Microsoft, and a few other smaller tech companies. These firms were large, good balance sheets, relatively low debt burdens. But if you fast forward to today, the last 6 months, the dynamic has changed. These companies have raised significantly more debt from the capital markets in order to fund AI infrastructure. And that changes the nature of the bubble itself. And it starts to change what happens if it were to pop. Back in September, October, November, I wouldn't have been overly concerned. Now, with how much these companies have raised from a debt burden, the interconnectedness between the AI bubble and the real economy is starting to grow. That changes the dynamic if this were to pop. Does that sort of make some sense?
So it started off when you first were writing about it, started off as a bicycle bubble, if you like, and it's moving more towards a 29 or an 08 where Main Street
and to be clear, it's still, even in this current form, not the most severe bubble that you would see. The most severe bubbles you see, the worst asset bubbles you can have, is when there is lending and there is a property element to it. Real estate changes the dynamic entirely. Look at what happened in the global financial crisis. Look at what has happened, for example, in China's real estate market. I don't want to go too off the topic here, but those are the bubbles that are most concerning and have the ability to cause the largest financial calamity out of the back of it. But this bubble isn't quite there yet because it hasn't really got this sort of property element. But the fact that a lot of these large companies, the Googles, the Oracles, the Microsofts of the world, are starting to raise quite large amounts of debt to fuel AI infrastructure, that changes the nature of the beast.
And that, interesting on that property element.
Yeah.
Would you consider then the sort of data center build out? Is that property real estate, or it needs to be a consumer property?
No. It doesn't need to be a consumer. No. It just needs to be real estate and property.
Okay.
Data centers as a proportion of sort of total real estate stock remains relatively limited. But yeah, there are certain challenges with some of these data center builds. And one of the things that we don't talk enough about is the challenge and damage that this does to certain communities, particularly around the amount of water that is needed to fuel a lot of these AI data centers. The impact on, say, job creation in the area tends to be fairly limited. You don't need thousands of people to run an AI data center, unfortunately. So the sort of environmental cost, the infrastructure build out, the debt build, the community issues, all of that does feature. Whether that feeds into a AI infrastructure property bubble yet, I don't think we're at that stage. But I'm still watching this and thinking the dynamics have changed a lot in the last 6 to 9 months as I've been writing about it.
Interesting. So not just the absolute level of prices, but the kind of dynamic under the hood of how we get there is interesting. Let me play devil's advocate or potentially.
Sure.
This may not be my actual view, but let me just run down this as an allocator and thinking about bubble and where we are from an asset price perspective. So, in the rates market, developed rates, real rates are at 1.5%, 2%, 10+ year highs. You're going to keep up with inflation and build, 1.5%, 2% on top of that, all else equal if that stays. That seems pretty good. I mean, it's not, 70s, 80s kind of good, but that in the last 10, 15 years post GFCs is pretty decent. On the credit side, spreads are tight, but corporate balance sheets are good. They're healthy. And actually, if you credit quality adjust some of these indices, whether that be investment grade or high yield, spreads look not cheap, but better, I think, than where they are if you just focus on the index level. And then on the equity side, valuations were expensive, more than one standard deviation expensive, if you like, versus history. But earnings continue to be good. And actually, valuations coming down, not because prices come down, but because earnings have kind of grown into that valuation a little bit. And we're only just starting to see the productivity gains priced in to corporate margins, corporate profits. If that was someone's view of the world as you kind of go through the asset classes, how would you kind of counter that if we were in the pub and someone said
certainly that's the sort of rose-tinted glass half full take on what I think is happening. Maybe just to push back on a few elements of it though. One of the things that I'm very mindful of around, say, for example, the impact that AI has had on earnings. Right now we're in this sort of what I would call this wait and see mode, where AI, there's been the build out of AI. We're sort of seeing the infrastructure rollout coming through, and we're seeing the adoption into the corporate mindset. I'm sure many of your listeners are starting to see AI pop up in their day-to-day in some sort of corporate function. But the jury is still out on whether this drives genuine earnings performance, okay? Now, what I mean by that is that I can tell you where AI is making a big impact. It's making a big impact on, say, NVIDIA's earnings releases, right? NVIDIA's are selling a heck of a lot of semiconductor chips off the back of all of this. But I'm mindful about people getting too excited about this. The reason being is that NVIDIA, it's a little bit of a difficult story to say that NVIDIA, when I look at NVIDIA's earnings release and I see these positive earnings numbers and everybody gets very excited, I have a very different take on this because I don't think that this is something that's a positive news story. And maybe to try and understand why, it helps if we go back a couple of hundred years and use a little example from the Californian gold rush. Okay. Yeah. During the Californian gold rush, everybody rushes over to the West Coast because there's been some gold discoveries. And people are panning, very excited, looking for gold, trying to find these little nuggets that they can sell. Yeah. And the thing is, very, very few people actually struck gold and found a material amount of gold to change their lives. But people got rich from the Californian gold rush. It just wasn't the people panning for the precious metal, right? It was the people who set up to support that. It was the guys selling the pickaxes or selling the new tools that you needed to go and look for it, or the guys that were sort of helping sell the food that these gold miners needed to try and stay alive whilst they were out on the West Coast. They were the ones supporting the gold rush that actually made the money. I can't help but think something similar when I look at, say, NVIDIA or some of these other chip producers, some of these other AI firms. Right now, what they're doing with NVIDIA, the earnings are looking good, but that's because they're selling the tools that others are meant to be looking to find gold. Now, how does this all come back to an actual earnings figure, and why I become a little bit skeptical of that rose-tinted narrative is that when I look at NVIDIA, I see a heck of a lot of gold pickaxes being sold, and very few people seem to have struck gold. Yeah. I am not seeing AI show up in the balance sheets and the corporate earnings of many non-tech companies. Don't get me wrong, I'm seeing a lot of chat on corporate earnings calls about AI and its potential benefits. And if I'm seeing it anywhere, I'm seeing it in some bottom line cost cutting as I can reduce some of my workforce. but genuine top-line earnings revenue growth that is needed to justify all of this AI infrastructure build-out, I haven't seen it yet. Not yet. Maybe it's something that will come in the next few months, hence why I think markets are now in this wait-and-see mode, as they have been for much of this year around a lot of these tech firms, but not yet. I haven't seen it. And for us to strike some gold, we need to see AI showing up, the benefits of AI showing up on non-tech sector balance sheets. And I don't think we've seen that yet.
Interesting. Yeah. And let's then take, you've laid out what would need to happen for the kind of upside case and for some of this to kind of come true. On the other side, and maybe we go back to those, I like the ingredients of a bubble. Maybe we go back to that. On the downside case, how does this end? Like, how could this show end if we follow the strand of your view that potentially it is an asset price bubble? What brings it to curtains?
So if I were, it's obviously always difficult to try and work out what pops a bubble. And I think when it comes to bubble chat, it's really very much done with the benefit of hindsight a lot of the time. So when you're in the middle of a bubble, sort of, it's something that we do need to be mindful of. So take my comments with a healthy dose of salt, perhaps. But a lot of asset bubbles tend to come to an end when there is material changes in underlying monetary policy, i.e. that interest rates stay high or move higher. And that is something that at the start of the year, I don't think was much of a concern, but now is starting to grow. The impact that the war in Iran and the closure of the Strait of Hormuz has had on energy prices is significant. The feed through into inflation will likely come through in the next sort of 8 to 12 months, meaning that a lot of the interest rate cuts that we had hoped for at the start of the year. In January, many people were talking about 3 to 4 cuts from the Federal Reserve. We've now gone to hoping for maybe 1, and even then I'm very skeptical of that. That may be enough to start putting a bit of a pin through a lot of these AI firms and trying to bring down some of the tech valuations slightly. The reason being is that a lot of those companies were banking on, or the valuations of those companies were banking on interest rates coming down and us moving into a lower interest rate environment. If we are now in a higher for longer rates backdrop, that changes the dynamic, not just for tech firms, but across the asset allocation spectrum.
I even saw this morning, Joe Zidell used to be the strategist at Blackstone, has now gone set up his own shop. He came out with a kind of non-consensus, almost base case of not just no cuts, but potentially hikes off the back of
absolutely.
And
I couldn't agree with that more. Like you look at this, for example, the Bank of England or the European central banks, the impact of energy prices will be severe. And one of the things that the central bankers are very wary of is destabilizing underlying inflation expectations. We've already just recovered from a bout of surprisingly high inflation in 2022. If we get hit by another one, what they're going to worry about is that changes the dynamics for whole generations that have grown up in a 2% inflation environment. If that happens, that's one of the reasons why I think you might end up seeing more rate hikes coming in the next sort of 6 to 12 months. And the markets, or at least when I'm checking the markets at the moment, they don't seem to be at all prepared for that.
Interesting. Yeah. More to come, as always.
Absolutely.
Let's move on then from one contentious topic to another. Let's go to, and a somewhat linked topic, private credit. So let's go there. And before we get inundated in the comments on this one, you know who you are, we're actually talking about a subset of private credit really called direct lending.
Sure, yes.
Which is the largest by assets under management. It's probably the largest subset. Senior floating rate debt embedded in companies for private equity sponsors to do. It's the leverage and the leverage buyout, right?
Absolutely.
And so we're not talking mezzanine, we're not talking royalty-based or special sits, we're focusing them. We'll use it interchangeably, so forgive us for that. You did a mini-series on private credit, a couple of notes on that. And I thought you really excellently compared the industry today, or the evolution of direct lending today, to kind of how humans understand black holes.
Yes.
Could you just explain that analogy?
Yeah. So I have to admit, I'd been thinking about writing around private credit for a while. And it was one of these ones, it took me about a year to write that note because I was sort of chipping away at it and I didn't love it. And this analogy kept creeping into my mind that in many respects, private credit, it's a very opaque asset class. It doesn't trade on secondary markets. There isn't really many indices that I can track that tells me how it's doing. And so I was very much like felt like I was looking at a black hole because I couldn't find any data on how it was doing. Like there were anecdotes and analogies and sort of the odd random report here and there, but it felt very much like you were looking into a black hole. There was no light. There was nothing that I could really try and touch. And so the only way that I could try and understand how private credit was behaving and whether the black hole was stable or not was not by looking at the black hole itself, but looking at how it was pulling on the other items sort of around it, those things in its orbit. And over the course of the last few months, those signals have not been particularly positive. What am I talking about here? I'm talking about the rising amount of distressed debt borrowers who are talking about doing payments in kind to meet their debt repayments. We can come back to that. The number of funds that are seeing large redemption requests, big area of concern. The number of those private credit funds who are now gating their strategies. All of this is a sign that the private credit black hole is not in a stable place. Now, the bigger question then becomes, what is driving this crisis? Because every financial crisis in history comes down to these two dynamics. Is it an illiquidity crisis? Or is it an insolvency crisis? That's the big dynamic. And this is the big debate within private credit at the moment, because illiquidity and insolvency, they seem related, but they are quite different. Illiquidity is where I've got good assets, I just can't sell them at a fair
good
market.
enough. Good enough assets.
Good enough, perhaps.
Yeah.
Good enough assets. I just can't sell them at a reasonable price right now, or a fair price, perhaps. An insolvency crisis is where if I were to take individual companies and look at their assets and sell them down, it is not enough to cover their liabilities. The problem is for investors is that an illiquidity crisis is something that I can roughly solve. With a bit of time, some patience, new capital can be deployed. We can get through an illiquidity crisis.
A B-REIT.
A
B-REIT scenario.
Exactly. An insolvency issue is much, much more complicated. And the problem is with the private credit black hole is because of the lack of data, because of the lack of information, I cannot be sure that what I'm looking at coming out of the darkness is an illiquidity problem or an insolvency one. And that is what is driving a lot of the concerns, I think.
Yeah. I mean, maybe chucking another thing in the orbit of private credit to try and figure out if it's illiquidity or insolvency. You're not seeing a mass pickup in defaults in the public high yield space.
No.
Now, those borrowers are not exactly the same. Some of them are, but most of them aren't. Is that a sign that it could be illiquidity? Like, would put it another way, would you expect there to be issues in public high yield at the same moment as private credit, or can those two things exist separately?
I think maybe 5-10 years ago, those two things will have sort of been somewhat broadly related to one another. But in time, these two asset classes, these two markets have grown quite far apart. Firstly, high yield, it lives in the light and it has had a lot of focus over the years. There have been crises. Investors sort of know what they're dealing with. And so if you're coming into a high yield strategy, there is at least some expectation that there will be defaults, there will be periods of distress. And the lenders understand this as well in terms of how they structure the contracts. This all trades on the liquid market, so I can see all of that. My worry is with private credit is that the market has grown apart from that. And what we've ended up seeing happen is this get marketed to people as this miraculous asset class that was low risk and high return. And for anyone who has been in financial markets for even a short period of time, you know that breaks the golden rule. The golden rule of financial markets is high risk, high return.
Yeah.
And we should have really had a lot of skepticism when private credit managers were showing these charts, showing, look at how low my risk dynamics are, look at how low my underlying volatility is. But great, look at how high these return promises are. And that's what worries me, is that has attracted in a lot of assets into an asset class that has really been, for the most part, slightly mismarketed or maybe misunderstood by the investment community. And now we're starting to see some of the problems emerge. All of that capital had to be allocated. Who do you allocate it to? Well, all of the good borrowers have already sort of been snapped up. So I'm going to lower my credit standards. I'm going to lend to those that shouldn't probably have been given this sort of funding. And what this has led to is a divergence between high yield and private credit markets. Instead, what we now see is much greater exposure to, say, tech firms. Brings us right back to that AI discussion we just had. And I see a much, much bigger weighting to US tech within the private credit space versus high yield.
Yeah.
And that dynamic is a big differential between how I treat private credit versus I treat high yield. So for your audience, I do not take any comfort from anybody saying, well, look, high yield looks stable.
Yeah.
Sure, great, but that is, you're not comparing apples to apples.
Different composition,
completely different composition, completely different marketplace nowadays.
That illiquidity and solvency, those two kind of pillars, is I think a great framework to think about this. But bringing in maybe a sort of a George Soros reflexivity story here, could the illiquidity or the structures that have been set up to house these loans create an illiquidity issue that is so large that it becomes an insolvency issue in terms of it gets to such a point that there isn't liquidity in the market to, the underlying companies might not be insolvent, but these loans get to such a place, the pricing, the underwriting standards get to such a place that the investor expectations push the market into a place.
Absolutely. Liquidity and insolvency, it's a useful framework, but I want to be very mindful. Trying to judge that in the heat of the moment is incredibly hard to work out whether you're dealing with an illiquidity problem or an insolvency issue. And you're completely correct. One could morph into the other quite quickly. For example, if you've got a private credit manager who is seeing large, persistent redemption requests, they are going to have to start trying to sell some of their underlying positions. Okay, the problem with that is that they're almost certainly going to look at their book of business. Yes, they're going to want to sell the high risk stuff, the concerning borrowers they would like to get rid of first. But in a crisis environment, there will be no market for that. There is barely any market to begin with in the private credit space, but those high-risk ones will not move. So instead, what happens? The manager has to start liquidating his or her higher quality positions first in order to try and meet these redemption requests. In doing so, you end up starting to weaken the overall quality of your private credit fund. If everybody's doing this all at the same time, it starts to become a bit of a pressure. Now, for those people who are sort of thinking about this and are thinking, well, hang on, there must be some opportunity here. There must be some way to take advantage of this. This is one of the reasons why we've seen a flurry of activity with people trying to quickly launch private distressed debt funds that focus on this space to try and provide that liquidity relief to the marketplace and try and take advantage of some of these managers who are trying to offload positions and will do so at quite sharp discounts to face value in order to just have some liquidity back again.
And they'll have a closed-ended drawdown structure to weather the...
Absolutely. Now, all of that works as long as this thing remains an illiquidity issue.
Yeah.
If this thing starts to morph, though, and we start to be worried about the insolvency of these firms and that default rates start to rise, then things start getting much, much more complicated.
A bit spicier.
Absolutely.
I don't want to overstress the analogy, but I think it was such a good one. I'm going to try and overstress it. One of the things in a black hole that humans struggle with is that gravity and quantum mechanics don't work together inside a black hole. So these two kind of fundamental theories of physics don't work. Now, if 70 to 80%, something like that, of the direct lending market is leverage for leveraged buyouts on the private equity side, and you have a UBS coming out with not a base case but a risk case that defaults in direct lending could get to 15%.
Yes.
Now, if you assume a recovery rate of 50%, which might be generous, but let's say that, then you're looking at sort of 30% of all of the borrowers in that direct lending market in trouble.
Yep.
Now, if the borrowers or the direct lending funds who've lent that money are in trouble, they're higher in the capital stack than the equity.
Sure.
And so if 30% of the lenders are in trouble, the equity's gone.
Absolutely.
And so, like, to that point around those two things colliding and not being able to coexist, I'm struggling a little bit with the amount of noise that's in the direct lending space at the moment from a headline perspective, and yet there's very little about private equity NAVs. Do you think that makes sense, that those two things are separate, or are we, there's something missing there?
Yeah, I think it's certainly something where what you've just laid out makes a lot of sense. I think the private credit space, due to its size and some of the marketing elements of it, means that it's sort of dominated the headlines a little bit more.
This is retail, more retail buy.
And like this is where I get a little bit angry, and this is one of the joys of having left JP Morgan and being on my own, is that I can end up saying things that would maybe otherwise land me in the problem with compliance departments. But I get really, really angry about this democratization of private assets marketing campaign that has been pushed by a number of quite large asset managers, which to me look like a desperate attempt to try and sucker in retail investors so that you can offload your distressed positions to another new entrant who doesn't realize what they're buying and hasn't sort of got to grips with the asset class under this banner of democratization. I thought the whole thing sort of stank to high heavens. And for me, when I started to see it getting pushed, was actually one of the first red flags, going back to that private credit black hole.
Yeah.
That was one of the first things that I looked at orbiting the black hole and went, that's not a healthy sign. That's not a healthy sign. This asset class, both private equity and private credit, they are designed for long-term, patient, institutional capital. What you've just laid out, I think eventually the challenges with private credit will wash up on the shores of private equity. However, I wonder whether we haven't seen it yet because of the nature of the underlying investor. Private equity still tends to be quite dominated by venture capital and institutional. Some retail money has trickled in some forms, but I don't think it's been quite as significant as some of the remarketing campaign that has gone on in the private credit space. Perhaps that explains it. But your theory and how you line it up, I think works quite well in my mind.
Okay, let's see.
Let's see how it plays out.
We're going to stay in fixed income.
Yep.
We're going to move from credit and the spicy end of credit into rates, right in your wheelhouse, sovereign borrowing, risk-free rates, et cetera, et cetera. So let's start with, you've written about financial market plumbing.
Yes.
And I was discussing this topic with a friend of the show off the back of your note, actually. I sent it to him. And he couldn't believe that I thought that this topic was undercovered, not
really?
Well covered. And I said, well, I reminded him that he's a rate strategist.
Yeah.
And so not everyone is a rate strategist.
Yeah.
So anyway, we're going to do it. You've written about the transmission mechanism between how central banks set overnight rates, this being Fed funds, Bank of England base rate, and how real people actually borrow and interact with the market, this being SOFR, etc., set by demand and supply in the rates market. So how does that work broadly? But also, you've written about some issues in the plumbing of that transmission mechanism potentially in the US. So what's been going on there?
So we're getting into a complex topic, and maybe just to unpack this, I think one of the important places to start is that the central banks do not deal directly with the real economy, right? They do not deal with consumers and businesses and individual firms. when they're trying to execute their monetary policy, they move interest rates, and the immediate transmission mechanism into the real economy comes via the banking system. And this is where things like SOFR come in, is that for them is the metric that they're trying to look at on how do I keep this keep this to where I need it to be in order to try and influence conditions in the real economy. Now, the challenges that the Federal Reserve have had over the last few years is that trying to control those short-term rates in the financial markets and ensuring that their policies transmit into the real economy effectively has become increasingly difficult. Why is that the case? Well, one of the things that we have been seeing is that governments have been issuing a heck of a lot of debt.
Yeah.
Now, when they are issuing this debt, what that is doing is it's sucking up the surplus amount of cash floating around the banking system. And this is where the plumbing starts to come in. By soaking up that cash, it becomes very hard for the central banks to control and influence short-term interest rates because the government is taking all the freely available cash in the system. Now, the problem is that the banks need some of that cash as well, right? When they get to year end or when they get to a quarter end, banks need to balance their books, need to make sure that they've got enough cash on hand. And so what happens is that we can end up with these short-term cash shortages. The problem then is that interest rates, these short-term, very short-term interest rates like SOFR, start to diverge significantly far away from where the Federal Reserve and other central banks want them. And so the plumbing starts to get broken. Does that make sense?
When we say significantly, this is significantly in the context of overnight rates.
Oh,
right?
yes. This is where your rates friend will say, oh, well...
A gigantic move.
Yeah. They will say it's gigantic, and I'll show you a chart, and it will be a few basis points.
Yes.
But in the world of rates, in the world of monetary policy, it is huge, and it matters. Now, the Federal Reserve have tried to take steps to try and solve this. One of the things that they've done essentially involves them buying short-term debt out of the market and trying to flood the banking system with surplus cash to try and manage this. What I'm describing for some of your more astute listeners is a little bit of stealthy quantitative easing that we've got in. Yeah, exactly. And so what the Fed have committed themselves to doing in order to try and ensure there are no blockages in the plumbing and to make sure that the gap between where they want interest rates to be and where interest rates in short-term money markets actually are is very, very close together. They need to be doing these sort of banking operations or bank balance sheet operations in order to keep the plumbing going. They started doing it in January. The system and the challenges seem to have been subsided. The problem is that central bankers have positioned this as sort of a temporary tool, something that they can use for the next few months just to get through this hump, and in time they'll take it away. Anyone who's followed central banks for a while knows that these temporary tools tend to have a nasty habit of becoming permanent fixtures of monetary policy. And this is one of those examples. If you take this tool away, the problem, you haven't fixed the plumbing problem. You've just taped over the top of it. You take the tape away, it won't have magically fixed the plumbing issues. So this will now be a permanent fixture of central banking policy. And what it does is it means that we will have central banks with much larger balance sheets going forward, okay, as they try and manage these plumbing issues that have been popping up in
some way
different
sort of
places.
offsetting government debt issuance.
Yes, absolutely. It does not fix the underlying fiscal policy dynamics, and we can talk about that in a moment, but it does help manage some of the short-term pressures in monetary policy.
Yeah. Okay. And let's go there then. So we'll continue on risk-free rates, but take a slightly different track. You compared them in a note to the Greek Titan Atlas, sort of holding up the world, if you like. What do you mean by that?
The risk-free rate. And what do I mean by the risk-free rate? Typically, US Treasury markets, or more specifically, most people focus on, say, the US 10-year Treasury, for example. That risk-free rate sits at the heart of pretty much every financial market calculation that we have out there, whether in equities or bonds. We rely on a risk-free rate. It's at the core of how the financial markets work. And that's where I say it's like Atlas holding up the entire financial system. And what I am worried about, though, is that risk-free rate is no longer risk-free. Atlas is starting to show some signs of strain, perhaps.
Not as strong as he should be.
Not quite as strong as he should be. Yeah, absolutely fair. And that is a worry for how the financial markets work. Because anyone who's listening to this podcast who has gone through university, learnt about financial markets or done the CFA, or when I'm teaching my students at university now about financial markets, we start with the risk-free rate. That is the core component. And you have to assume that the risk-free rate is exactly what it says on the tin, risk-free.
Yeah.
The growing level of indebtedness by many governments around the world suggests that risk-free rate is no longer risk-free, and that starts to change how we think about the wider financial system.
Yeah, I mean, you've written about this as well, and this is one of the craziest things that I didn't know, frankly. Coming back to that kind of fiscal strain, we won't need to stress that for UK or French, specifically French listeners, but there are 80 French corporates whose debt has, in terms of yield, has gone below that of the French government. So in theory, they can borrow from the market cheaper than the French government. Whether they have or not in the primary space is different, but in the secondary space, their yields have been lower than the French government. Now, I guess the counter to that is that in euros, and the risk-free rate's always the sort of government curve for the currency, I guess. Risk-free rate in euros is the Bund curve, not the French curve. However, that's super funky that L'Oreal can borrow more cheaply than the French government. And then even in the US, the Apple 2031 bond, I think, trades like 9-10 bips wide of the Treasury. So that's some weird stuff.
Yeah.
So you kind of touched on that. But, what are the implications if a government curve isn't risk-free? And what are the alternatives? Is it you take the best corporate in the country? Like, what are the alternatives to this?
Yeah, absolutely. Like, and this is where we get into some really wonky stuff, because this concept that government bonds should be the risk-free rate is just a basic cornerstone of financial market investing.
Yeah.
And so if you start to pull up that cornerstone and think about what could go in its place, we end up in some odd places. So, for example, should we be focusing on high quality corporates as a potential solution? Should, for example, a AAA name like Apple actually be more of a risk-free rate than a AA US Treasury rated bond, for example? Like, that's a sort of interesting dynamic. And in this note, I sort of explain it this way, is that if you were to think about the government as a corporate entity, it's heavily indebted. Its tax revenue, i.e. income, is below that of its expenditure, forcing it to borrow consistently over time. The leadership of it is incredibly chaotic at points.
Yeah.
If it were a standalone company, I wouldn't necessarily think it was the most trustworthy one.
Well, the UK might be in the private credit space.
Exactly.
Actually.
Meanwhile, absolutely. Yeah, maybe let's not go down that rabbit hole. But let's say compare that to Apple as a AAA credit name, huge cash balances, big established income stream, very limited liabilities, and a strong balance sheet. I know which one I think is probably closer to being risk-free when taken through that optics. Now, I'm being a little bit facetious. Governments have the ability to print money, and that is the sort of distinctive difference between that and Apple, which obviously changes the dynamic slightly. But in a world of rising levels of indebtedness and growing interest burdens and the inability of politicians, not just in the US here, but here in the UK and elsewhere in Europe, to deal with persistent deficits, means that at some point we will start to see Atlas crumble. We will start to see the risk-free rate no longer be risk-free. And I do think some people will think, well, maybe we can put corporate bonds in there. AAA corporates might be a solution. Another idea that has been touted is that we move towards a system where you say, I'm going to put gold in there as the risk-free rate, or some sort of precious metals exposure. That can work potentially, maybe. It's fraught with difficulty. Gold is highly volatile, as many gold investors will talk to just for here in 2026. Maybe what we start to move to is a basket of goods, or, for example, maybe we move to, say, a basket of AAA rated names. Australia, Switzerland, Germany still retain their AAA credit ratings. Maybe they're the ones that we should be using as the risk-free rates, whilst more heavily indebted nations end up getting shunned. Just as a couple of ideas. But we do certainly, when we start peeling this back, world gets wonky very quickly.
Yeah, I mean, you just mentioned 3 names that have 3 different currencies.
Yep.
So trying to bring together a dollar risk-free rate with 3 currencies that don't involve the dollar. I mean,
absolutely.
We get to a weird place.
It would be chaotic.
Fast.
You get to a chaotic spot. But these are the questions investors are going to have to tackle. You do not need to be a fiscal expert to look at the debt to GDP ratios of the US, of the UK, of France, and go, it isn't heading in the right direction. Solving debt crises is difficult. We know how to do it. We've seen it before. Debt to GDP ratios here in the UK have been way higher than they are today. There are 2 ways to solve them. One is that you build political will across all parties to reduce the debt to GDP burden. This happened in the UK in the 1800s. After the Napoleonic Wars, debt to GDP ratios in the UK got excessively high, well above 100% of GDP, closing in on 200%, if I remember this off the top of my head. And what ended up happening is the political parties came together and they said, look, this is unacceptable for the status of the UK. We need to run persistent budget surpluses in order to get the debt to GDP ratio down. Yeah. And they did it for over 100 years. Persistent debt to GDP ratios, and they got debt all the way down to about 25% of GDP. That's one way out. The other way out is that you grow your way out of your debt burden. And that's what happened after World War II. After World War II, we saw a miraculous recovery with the Marshall Plan in Europe, the rebuilding after the war efforts. Another very big underappreciated element of that was women entering into the workforce. That massively expanded the economy and its output for a long, long period of time. And so we had that reduction in debt to GDP ratio there. The problem today is that when I look at those 2 options, I cannot see how you accelerate growth today quickly, and you have that productivity and labor market gains needed to expand the economy out of its debt burden. So that option feels difficult to implement. And the second option around political goodwill, I just do not see happening at this point. Yeah, good luck to that. So with those 2 aspects closed, you, as investors, and you look at the long term, I don't see any sort of other way out of this dynamic. And that means that these wonky questions around what constitutes a risk-free rate need for us to be tackled, because I can't understand how we're going to get out of this.
So if they're the 2 good options out, a bad option out potentially would be where your body of research is, which is you walk away from it and is a default. So if you don't see those 2 good versions of the future, does that mean you see, crystal balling you here a little bit, but do you see then that as an option for Western economies in some kind of fabricated way, perhaps?
So all of my research focuses on sovereign default in the context of small emerging market economies. And it is calamitous for those economies, whether that's Grenada in 2004, Mozambique in 2016. These countries, when they default, cause huge amounts of devastation to the local population, and the economy can take years to recover off the back of this. But these are small parts of the overall financial system. The idea of trying to contemplate the idea of, say, the US, the UK, Japan, that we haven't talked about, defaulting and walking away on its debts is enough to send an absolute earthquake through financial markets. Bearing in mind that we're talking about it being the risk-free rate, if it moves to a point where we're not even saying, it's riskier, we're actually saying it's highly risky.
40 cents on the dollar kind of stuff. Yeah.
That world gets scary very, very quickly. That's the sort of crisis that has enough to sort of bring a bit of a very sharp, sudden stop to the financial system. And it's not really something that we've ever seen before. If I spent too much time thinking about it, Alex, I think I wouldn't sleep much at night. But it is a prospect, the idea that actually you default on your debt. Instead, what I think is more likely before we get to that extreme end scenario is that what we will end up seeing governments do is stage a bit of a fight back, and that they start adopting financial repression. Okay, what this looks like in reality is doing a lot of tinkering and tailoring around the debt burden to try and manage it, to try and inflate it away. Doing things like, for example, changing your banking and pension rules to insist that banks and pensions hold a greater amount of domestic debt, just as a little example. Or saying, actually, I'm going to implement capital controls to stop domestic investors buying overseas assets and force them to stay at home. That's powers that the developed market governments have at their disposal. We haven't really used them much in the last few decades, but I think that's the sort of thing you're going to see more and more and more of as governments try and find ways within the rules to force people into buying their debt in order to keep the balance sheets managed. Now, all of this still is a managing mechanism. I don't think it solves the problem, but it does allow them to keep their head above water, and it prevents us reaching that scary sovereign default thing that keeps me up at night.
Yeah. Fascinating, and probably, unfortunately, for our lifetimes to see the results of some of that. Okay. We're just going to end with one final question. So given this podcast is called Tracking Error,
yes,
we're always on the hunt for things that are different to consensus.
Yes.
Because if you think the same way as consensus, it's largely in the price. The value comes in, have it being or thinking differently to that. So there's a wonderful quote that I love, always have done. It's attributed to Mark Twain, but there's absolutely no evidence he said it, as with a lot of Mark Twain quotes. And it says, "It ain't what you don't know that gets you into trouble. It's what you think you know for sure that just ain't so."
Absolutely.
And so with that in mind, for you, what is the sort of investing lesson, view, heuristic, commonly held kind of, view that you think could be just wrong? Or on the flip side, if you want to go that way, something that people just overlook?
Yeah, absolutely. So one that I'm very focused on at the moment, and I keep sort of talking about on LinkedIn and getting quite a lot of LinkedIn heat from, is that I'm a little bit
Does that happen on LinkedIn?
Oh, absolutely. It happens on LinkedIn. So one of the things I would say is around commodities. So we are now experiencing, as of the end of March of 2026, the 10th consecutive month of inflows into commodities funds, which is a record amount of consistency. Now, the thing with this is that I understand why investors are buying commodity funds. They're worried about inflation, and they're trying to look for asset classes that can protect them. And commodities has been typically touted as one that, in theory, should protect you against higher inflation. The problem is that people don't really understand how commodity funds operate. And this is something that will potentially get them into trouble, because commodities might not protect you in the way that you think they're going to protect you. First off, commodities as an asset class is not really one homogenous block, right?
Yeah.
There is very little in common between energy and agriculture, or livestock and precious metals.
Yeah. Similar to hedge funds.
Absolutely. And grouping them all together into one asset class and calling it commodities and hoping that magically makes them all move together is a bit of a mistake for investors.
Yeah.
In reality, a lot of those commodities are not correlated with one another. And so just because one can surge higher, another can collapse quite quickly. That's the first problem. The second problem is that investors are not really thinking too much about how commodity funds actually work. So when I look at, say, an equity fund or a bond fund, those funds are holding the asset in question directly. And that means that if prices change, it will quickly show up in the value of the fund. Now, the problem with commodity funds is they do not hold the asset directly. That managers do not have some sort of secret warehouse or some office space where they've stored all of their oil, or that they've got bars of gold stored there. What they do is they get their exposure through the futures market. And that dynamic changes the return profile of those commodity funds. Suddenly, what we're talking about now is not just the price of the metal or the price of oil, but what the futures market thinks that price is going to be over the next 6 to 12 months.
Yeah.
Now, I won't go too far down the rabbit hole with how that futures market impacts on your prices.
But it's interest rates, it's shape of curves, it's this kind of stuff.
Absolutely. And that's one of the things that I don't think investors are fully understanding about how commodities markets work, is that futures shape matters a heck of a lot to your return profile. And it can change very, very quickly. And that's one of the things where actually we might be buying this commodity exposure, hoping it hedges against inflation, but the futures markets will swing very, very quickly. And suddenly you find yourself with a commodities fund that is down when you're hoping it's going to be up in a sort of higher inflation environment. Does that make sense?
Yeah.
That's where I think investors will potentially find themselves getting their fingers burnt.
So does that mean you would suggest people be more specific?
Absolutely.
Down to the single commodity level? Or you think that's, for most people allocating, that's a little bit...
I think one of the things that I'm finding really frustrating, and I really can sometimes be very boring with asset allocation, and I'm seeing a lot of people talking about diversifying their diversifiers and getting really specific into their commodities. Sometimes in these environments, some of the best things to do is to de-risk and move into some very unsexy places like cash. One of the things about cash, it's not sexy. Yes, it loses money in real terms in a high inflation environment. But you know what it doesn't do? It doesn't fall in nominal terms. It doesn't collapse on you like equities, bonds, or maybe even commodities. So actually, I'm very unsexy. Sometimes there are points in the investment cycle where the best thing to do is to try and just mitigate your losses rather than keep them trying to maximize your returns.
Fantastic. Let's end there. That was awesome. This should go without saying, I think now, and I'm sure a bunch of people have already navigated to Financial Fables. Substack's the best place for that?
Yeah, Substack's the best place.
So I'm sure people have already navigated there and hit subscribe. But if not, get to it. We'll put a link in the show notes for that. And as a Tracking Error guest, you get to keep the highly desirable Bridgewick Partners Yeti tumbler. Great for coffee and cocktails. I haven't tried the cocktails.
I'll try that later.
Marketing.
I'll try that later. Fantastic.
Not available for purchase, only clients and guests of the show. So highly desirable. Alex, thanks for coming on.
Thank you very much for having me.
Thank you for listening. We'll be back next month. Go well.
Cheers.